When you allow global unification of central banking completely in stealth without consent of the public, madness will follow. When you allow your currency to be devalued, the unimaginable will occur. When you think that you have nothing left to be taken, they will remind you and grind you down. The vast majority of people have no idea what happens to them. They spend, and one day the economy all around them has shut down. They didn't even see it happening. Then years later, the pattern repeats. Over and over, they make the same mistakes. Never prepared, always asleep. You came here for the truth, so let me unveil that for you. I wanted to set the tone for this video. I'm going to show you some interesting information today. You can go to the news, you can get the data that they provide. I can show you the U3 unemployment rate. I can give you the official numbers that come out of the BLS. I'm going to look at certain statistics that are differing simply to give you an alternative to the mainstream. That's what the Money GPS is all about. If you're interested in the U3 unemployment rate, I don't need to show you it here on the channel. You already know what that is. It's headline news everywhere when the data comes out. What I'm trying to show you is full spectrum. If you want to see unemployment rate, you don't just look at the U3 number. Even the BLS themselves provides other data that you can look at to give a better idea of the employment situation. I try to look at as many indicators as I possibly can for any particular fact. If you simply rely on one or two numbers, you're never going to understand the whole picture. Today we're going to look at a few things that I believe are so important right now. We're going to cover the whole spectrum. Let's begin. This is talking about the Federal Reserve. I polled the audience of the Money GPS, and overwhelmingly people believe that they are going to decrease interest rates this time around. They're not going to increase them, and they're not going to leave them where they are. People believe that now the Federal Reserve has got themselves in this cut after cut after cut, not a mid-cycle adjustment, but simply a pattern all the way to zero and perhaps beyond. Market-based probabilities imply a 93.5% chance of a 1/4 percentage point reduction. This shows you where we are today. Structurally, we're not sound. If we were, you wouldn't need to bring extremely low interest rates down even further. Where they were before was already so accommodative, as they like to use that word. You don't need to bring it down further. Out of the AP, a measure of hiring by U.S. companies has fallen to a 7-year low, and fewer employers are raising pay. Now, if I were to look at the U3 unemployment rate, if I were to look at the jobs numbers we get every month, that's not going to tell you what this information does. Just 1/5 of the economists surveyed by the National Association for Business Economics said that their companies have hired additional workers in the past 3 months. That is down 1/3 in July. Job totals were unchanged at 69% of the companies. That is down 1/3 in July. A broad measure of job gains in the survey fell to its lowest level since October 2012. They're showing here in this article different statistics that go along with this. We're talking about the trade issues, talking about China and the US. They're blaming Brexit. They're blaming the sun not coming up. Just 1/5 of the economists surveyed by the National Association for Business Economics said that their companies have hired additional workers in the past 3 months. That is down from 1/3 in July. A broad measure of job gains in the survey fell to its lowest level since October 2012. Now, there's more in here if you want to read through it, but all I'm trying to show you is that it isn't one-dimensional. People always quote, and I see it in the comments, I see it on television, see it in the articles, 50-year low for unemployment. It's fantastic. We've never been this good. But of course, if you only knew how the unemployment rate was calculated, you would never embarrass yourself like that ever again. The US economy appears to be slowing, and respondents expect still slower growth over the next 12 months. This isn't because of Brexit. This isn't because of what's happening between China and the US. This is an overall slowing economy that we have in any late cycle. We always have this engine running on fumes. The market doesn't figure it out because they're saying we can get some more out of this. But ultimately, that vehicle can only go for so long. Retailers say that they expect American consumers to shell out a whopping $8.8 billion this Halloween on costumes, candy, and pumpkins. That figure may sound massive, but it represents the second consecutive fall in annual spending, a worrying sign for a consumer-driven economy. Everybody knows that the US economy is largely relying on the consumer, not just paying for stuff, but going further into debt. This is important on all levels, whether we're talking about student debt, whether we're looking at personal loans, mortgages, line of credit, home equity line of credit, any form of debt possible, they have to go further and further and further. And this needs to happen all throughout the cycle, okay? As things are getting worse, there are advertisements and new programs available bombarding people, trying to get them to go deeper and deeper. And we know this, we've seen it every year. It gets worse and worse and worse, and people fall for it. Why? Because it's keeping up with the Joneses, or maybe the Kardashians, maybe their expenditures have increased. Whatever the case may be, we see that this is a continued problem that is worsening, particularly since the financial crisis. Out of the Atlanta Fed, we get the GDP Now indicator, and this is something that I have shown you many times before. I'm sure you're aware of it. The latest forecast is 1.7% as of October 28th, 2019. Here you can see the chart that is associated with that. This goes back from June up until the present. I just showed you a statistic, I think it was yesterday's video or the day before, where they are forecasting 0.92%, I think the number was. Depending on who you are reading this data from, they're going to show you some different stats. Ultimately, it is always showing weakness, particularly after any revision. This is what they do time and time again. The headline number always shows strength, but underlying that, it seems like there's some real serious discrepancies there. 82% of companies reporting have beat estimates, well above the historical average. Isn't that interesting? Well, of course, with stock buybacks, with what central banks have been doing, extremely cheap debt. They've been issuing debt, of course, themselves, all these corporations, and we've watched as a lot of this garbage has piled up, and investors have been buying it, and they've been using leverage, they've been using margin, they've been using every possible method in order to stimulate these markets further and further, but ultimately something has to give. Companies that missed have been punished less severely than in the past. And this is interesting because what we had seen before was that if a company doesn't hit where they say they were going to be, the stocks would get pummeled, and you would see all of the different analysts out there saying, sell this stock, downgrading it, and it would be shunned into the corner, given a timeout, but not so much anymore. Now, simply, it's risk on. It is all of these investors looking at what the Federal Reserve is doing and saying, we know the direction of the stock market because the Fed said so. While companies that have beat have outperformed robustly, and you could see just showing you here this data correlated to what I had shown you a moment ago, median rally on earnings beats, essentially just showing you that when they do well, they do very well. S&P 500 earnings per share growth for the quarter expected to come in at 0.6%. This is the year over year looking very weak. Haven't seen it this bad since what we had during this 2015-2016 timeframe that I talked about many times. Essentially a recession that was pumped up by central banks around the world. Of course, we know what is different today, and that isn't very good as a sign. 2020 earnings estimates look too high relative to global growth expectations. And you could see the global PMI versus the MSCI All Country World Index earnings growth. The green line is the PMI, blue line being the earnings per share, ultimately just showing us that this isn't a good sign, but nobody really knows until it happens. In Europe, those missing have remarkably rallied compared to the usual sell-off. Think about this. Median sell-off on earnings misses. So you didn't exactly get to where you wanted to be and you were rewarded anyway. How fantastic is that? It's like all these companies are given a trophy for participating. Well, you tried. Here you go. Here's another few billion. There are two charts here that I wanted to show you. On the left-hand side, equities have historically peaked when unemployment troughs. And you're looking at this here, yellow line being the MSCI World, and the blue line being the OECD unemployment rate, just showing you what has happened. You could see just, for example, with the U3 unemployment rate that is provided to us in the United States, always time and time again, we see it dropping all the way to near record lows or record lows. And then out of nowhere, we see things change very quickly. So it's always going lower, 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 lower until a certain moment when businesses finally realize that there is a recession, usually way too late. They start laying people off, unemployment rate goes up. As you can see in this chart here, it applies not just to the United States, but to the OECD in general. On the right-hand side, peaks in consumer confidence tend to coincide with peaks in equity markets. I found that to be very interesting as well. The blue line being the consumer confidence, the yellow line is the MSCI World. I like to look at the MSCI World Index because this gives me an idea globally how things are. In the United States, you're going to get some skewed information, or if we focus on just Germany, we're going to get some skewed information. We want to look at this, yes, on a country level, but also I want to see it on a world level too. This just shows you right here that we should be paying close attention to this. That's all for this video. If you found it informative, hit that thumbs up button, kick that button, punch that button, do whatever you got to do. I appreciate it very much. If you want to make money, if you want to learn how to build an online business, then this is for you. I created a free e-course for everybody to learn. Even if you have no experience in this at all, at least get the knowledge and see if it's right for you. It's available at the AmazonGPS.com. If you want to learn about the financial system and how it is there specifically to keep you out of learning the real data, the real deal, then you got to read these two books. It's going to explain everything. Definitely check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Wait a second, don't go anywhere. You got to watch this video. Have you seen it already? If not, click on it and I will see you over there.